You're listening to the Metaroy podcast and welcome to a brand new episode with your host, Roy. Every week on this show, we learn and unlearn about one aspect of the crypto world. We are talking today to Rorke Kuttel. Rorke is a digital asset hedge fund manager and the CTO of THEIA, which is a decentralized and permissionless investment and trading platform that allows anyone to instantly create a collective or project and start raising funds. Rorke is really passionate about computer graphics, video games, and AR/VR. Rorke, thank you for joining us today, and I really appreciate you taking the time out for this interview.
Yeah, thank you for having me, Roy. I'm really happy to be here.
And while you guys are listening to this, if you're new to this show, do hit the follow button on Apple Podcasts, Spotify, or any platform of your choice, and stay connected with me on Twitter or Instagram to be notified about new episodes. I would really appreciate it if you left a review and feedback on my website, themetaroy.com. Before we start though, just a quick disclaimer. The following content is informational only and none of it should be interpreted as financial advice. So please do your own due diligence before making any moves in the crypto space. So with that out of the way, let's get started with speaking our guest today. How's it going, Rorke?
Yeah, it's going good. It's going good. Yeah, I mean, so far, been a busy day, but good. Yeah, really good.
Rorke, can you take us through your background and your experience with Web 3.0 and how you got started in this space?
Yeah, of course. So I think my first exposure was a lot of same for a lot of people. Like I just bought some Bitcoin in high school for some admittedly nefarious purposes, like not super above board. It wasn't really an investment. But beyond that, I wasn't as plugged in then, but really things started getting a little bit more intense in college. So I studied computer science in college, but I specialized in, as you mentioned, computer graphics, but augmented and virtual reality design. That was my specialty. And I really enjoyed working at the knife's edge of an emerging tech, like something that was just coming out really. And really how it kind of ended up happening is I did a lot of school projects, projects for classes and group projects. And then those turned into personal projects, personal experiences, games, all that kind of stuff. And then you get into Discord groups, and then Discord groups turn into other Discord groups. And then soon enough, really, I was starting to rub some shoulders really informally with some of the guys who were doing the heavier lifting on some leveraged digital assets like the NFT standard, but like 2018 territory, 2017 territory. And so like I got some Decentralized plots like pretty early on, and then it kind of got financially involved in a small way, but because I was always really connected to that space, and I got to overthink the process coming from both a gaming background and then also a VR background as well. I just really wanted to stay connected, and so then as a result, I was there for a lot of the earlier PFP mints, like the 8 mints, like and then like that pretty much the entire 2021 like ride up on and all of that. And I got financially involved, and that's a lot of fun. Obviously you get to hold some things that appreciate quite significantly, and so then that's actually how I rolled my personal portfolio into the hedge fund I now manage for some traditional finance partners in New York. So there's some older people like hedge fund partners, bankers, that kind of thing. And they all wanted the exposure, and, they kind of put some capital in, and then I put my assets in along with some capital of my own, and we kind of went from there. But it was really this back way through into Web3 for sure. I didn't come from the dev side. Like I didn't really hop into the nitty gritty of the dev side very early on. And it was all really just about the implementation and the use cases and coming, I think from gaming, but also really specifically a lot of really involved gaming like RPGs, JRPGs, where it's like perpetual live service. The concept of like play to earn, it had kind of been like always my life, like, or play to own, like that kind of thing. Like I'd always known about guys like spending $20 to get this item on World of Warcraft from somebody else, or like EVE Online, like thousands of dollars going around for ships, but it's all like underhand deals, like all this kind of like stuff where, it's, and I always just thought there's got to be a better system for that. And I knew that there was some sort of way in which you could have a collection of your whole gaming identity, really, and all the stuff you've accrued, and be able to just own it and move it or do whatever you want with it. And that was really what I saw in something like the NFT standard, and that's what really got me very excited, just for that one use case, not even all the other stuff that you can really do with that. And that's where I started there, and then it very quickly ramped up into how I really got involved, and then obviously how I got involved with THEIA, and kind of seeing some of the problems in the market, and what we wanted to solve.
How did you actually arrive at this idea?
Yeah, so coming from obviously the NFT side of things, like 2021, it's a gold rush, right? It was a lot of fun. Like there was a lot of success. There was a lot of like wild stuff going on, and it was crazy. And people only really started piling in a huge way towards the end of the year. But even during DeFi summer, 2021, like it was hot. Like there was a lot of stuff going on. But I was kind of seeing the writing on the wall, and I was knowing that it was going to turn into a bit of a gold rush, and a lot of the market was going to be driven by speculation. And as a result, when you get a lot of speculation, especially with a system that's as easy to be anonymous and collect funding as crypto, you lead to a lot of rugs. You lead to a lot of scams. You lead to a lot of, just because it's very easy to do, right? Everybody assumes that the signature they sign is going to be the next 1000x project, and so they don't think about it, right? And you can't blame them, right? Especially when it's all so fast, when it's like, week to week to week to week, people are making like day to day to day, people are getting in on things. And so there were a couple pretty notable rugs during that summer. And basically, one of my friends, who's now my co-founder, he was rugged pretty hard by Evolved Apes. That was like one of the pretty funny first mainstream rugs. And he had been approached by one of his friends from high school, who is a token engineer now. He went to London School of Economics, and he dropped out to be a token engineer. His name's Nikita. He's also a co-founder. And he came to him about this concept that he was doing for this protocol. And it was originally kind of with a different scope, and it had a different form. And then when Larry, who's the friend of mine that he's one of the other co-founders, he came to me, we were having this conversation in like midnight in July about something that I was doing with NFTs and all this stuff. And he was telling me about, he was trying to get into it and he wanted some advice and all these other things. But then he also came to me with this concept and was like, hey, can you look at it? Like, you have a little bit of market experience. You have a little bit of technical experience. Can you just look at it and tell me if it's feasible? And so then I got on a call with Nikita and him, and they sort of pitched me the idea. And I very quickly, or say we very quickly figured out that it had a lot of solutions to some of the biggest problems that I saw with like the NFT space. You know, the idea that there's all this money up front and then they're delivering later with it. And that results in a lot of rugs, and there's the problem of curation. There's the problem of like, who should you trust, who shouldn't you trust, and that was all really in August that I was kind of seeing some of those things form. And so, yeah, really it all kind of kicked off from just a conversation late at night, but we all came from different backgrounds. Like Nikita came from this token engineering background, and he saw a lot of the issues with, or he knew that there were like more, you can always evolve token engineering. There's like a million different ways you can do that in tokenomics, and kind of what solutions are you trying to solve there? And then Larry came from a VC background. Like he'd worked in finance, he'd worked in VC while he was at college at Columbia, and he knew right off the bat how frustrating it could be for founders to get funding, which is why like the ICO was so popular, which is why the NFT drop was so popular, which is why crowdfunding was so popular for so long, because it was just like this, it's this way to at the very least get something, get your idea out there, right? And for me, I kind of came from the like NFT side of things, the market side of things, I knew what was going on there, what was good, what was bad, or at least I thought I had some pretty good experience, and so we all kind of came together and took these perspectives that we had, and we brought them together and reforged what the idea was originally for THEIA, and then kind of engineered it to be what it is today, really.
Can you just elaborate on how it actually helps the creator economy? Like, what are the aspects of THEIA and how does the economic model work?
Let me start with the protocol, because so we're building two things with THEIA. It's a novel protocol, and then we have an investment platform on top of it. But the protocol, in short, it's all about security for investors. So the protocol does two things. We guarantee liquidity. We offer predictable pricing as well. And how we do that is we create a degree of separation between an investor and the native asset that a project's providing. So like, let's say a project is making a coin or even an NFT or something. When an investor invests on THEIA, they're not buying the token outright immediately. What ends up happening actually is the project deposits an allocation, whatever they want to allocate for the raise, into our smart contract. And then when an investor comes to invest, they invest into the smart contract, and the smart contract basically mints them representative tokens. It's like they're almost like synthetic tokens in some way. Some people like to draw an analogy there. And basically, we call these representative tokens project tokens. And because we have that separation where you're not just buying like the NFT directly, you're buying like an instrument that represents it, we can set some rules for how those tokens function. So a really good example is not all of your money goes to the project up front. Actually, a minority of your money goes to the project up front. The project sets what's called a commission rate, which can be no higher than 20%. And basically that represents the money that they get from an investor up front. So let's say it's like 5% for ease, and I invest $100. $5 goes to the project up front. That is theirs to do whatever they want with. They can spend it, they can hold it, whatever. It's their money. The $95 gets locked in the smart contract. And basically, our protocol can use that $95 to buy back my own investment if I don't want to be committed to the project anymore. So I can sell my representative tokens back to the protocol without the need for a counterparty, and it'll buy them back. And so then basically that's kind of like how we guarantee liquidity, because you can always sell back to the protocol. And how the project actually unlocks that $95 is they have to reach what's called a minimum funding threshold, which is what they set. It's basically the minimum amount of money that they're comfortable raising up front to begin proving to investors that they're worth it, basically. And then once they do that, it kicks off what's called a conversion period, the length of which they set as well. And during this conversion period, investors can choose entirely whenever they want at their own autonomy to convert these representative tokens into the proportion of the native asset that they're entitled to as a result. It's basically pro rata, it's proportional. And only when they do that is the majority of the money that they deposited into that smart contract unlocked and sent to the project. So it's basically the project has got to prove to investors that they're both legitimate and then building something that's worthwhile. And then only then will they receive the majority of the money from an investor. And all the way up until that point, an investor has all the opportunity to engage or back out or invest more or whatever, because the liquidity is guaranteed. And the reason that this is, helpful for investors is obvious, right? You're not going to get rugged as much, or nearly as much at all. You can invest, you can at the very least get back close to your principal, sometimes even be flat, sometimes even make a gain as a result of leaving a project. And there's that kind of guaranteed liquidity element. But when it comes to projects, the big problem for projects, the big problem for creators, especially creators, is the only way to get involved in Web3 is through like something like an ICO, a social coin, or like an NFT drop. The problem with all of those is the fundraising event is constrained to a really short period. Like an NFT drop, it's like if you don't sell your NFT drop within 24 hours, you're screwed. Like your project is dead in the water. Everybody thinks it's a soft rug. Your reputation's kind of tarnished. It's really not, it's not healthy. And then the worst part still is once you fulfill that mint, you're adopting immediately the shortest term pressure to perform. Like if that floor price starts to drop and it doesn't seem like there's utility right out of the gate, everybody's assuming you're rugging the project. You can't experiment. You can't back out. Like there's a lot of, it's a rough position to be in. And so we wanted a system in which a project or a creator can accrue value from the community that they're trying to target over time in a healthy way where investors don't feel like they're fully exposed, right? Like I didn't spend $1,000 on something. I need it to work. Like I'm committed in some way, but at the very least, like I have the option to leave if I want to. And that we feel that you can then stretch that fundraising period out over a much longer period of time and just healthily prove to investors that you're worth it, and then get to a stage that, okay, when everybody's ready to be fully exposed, it's because your product is there. It's because you're there as a creator. And also, a big part of these representative tokens is that they can be representative of anything. We've designed the whole system so that these representative tokens can be converted into a fungible token, an NFT like collection, fractionalized NFT. And then as a result, we can really leverage the full extent of DeFi. So like if you're like a musician and you want to create a fractionalized NFT and then divert the royalty rights of a song to that fractionalized NFT, for example, you can do that on our platform and then raise money for like an album, and that really solves a big pain point for musicians who don't want to do like an NFT drop, right? They want to just focus on the thing. They don't want to focus on like all this other stuff, and so that's a really, big part of the protocol that I think it builds, it's all about aligning incentives, basically. It's all about bringing founders and investors back at eye level. But when it comes to, that's just the protocol layer. We've actually built a social investment platform on top of all of this. And what that social investment platform entails is what we call collectives. So collectives are basically our way of decentralizing the due diligence process. So we feel that whether it's like launch pads or even stuff like DAO Maker, or even to an extent investment DAOs, but really launchpads which are like the principal way of raising money for a lot of projects, is an antiquated approach of looking at the fundraising concept in Web3. Because at the end of the day, they're kind of reskins of like accelerators, something like Y Combinator, where it's like applying to college. They're this one team that's kind of small, maybe 10, 20 people if they're big, and they get thousands of applications from thousands of companies across thousands of verticals. And as a result, they're inevitably constrained to a single vertical. Like they can only handle like crypto infrastructure, or they can only really handle like retail, or they're very constricted in their addressability. And then also they're often constricted in the chain that they can operate on. That's why you have like Polka Starter versus, Avalanche, or like, DAO Maker or Binance Launchpad. And then some of that's by design, but some of that's just consequential. Like, they just can't really address like other chains because they just, it's too much. And also, when it comes to investing in actually these, launch pads, a lot of the time they're token gated. A lot of times, if you want to even get considered for a launch pad, you have to like buy their token, which is, like the idea of making a capital investment to get money is such like a weird thing. And so basically what collectives are DAOs on the platform that do due diligence and onboard projects onto the platform and are rewarded for doing so. So basically the actual flow for a project getting on THEIA is that they create their project profile, they allocate, their economics, all of that kind of stuff. And then when they create it, their profile, they're put onto the platform and they're listed as what's called unlisted, which means they're not investable yet. In order to become investable, they basically have to be onboarded by a collective. So either they reach out to collectives or a collective reaches out to them through our system, really simple notification system. And the collective can do whatever due diligence they want to do. They can look at the team, they can interview, whatever. They can just look at the project and say, we think it's cool. And if they give it the thumbs up and then the project accepts it, basically, they're onboarded onto that collective and they become investable. And then that collective becomes the only destination on the platform to invest into that project. And as a result, the collective sets a commission rate for every investment that goes into that project. So let's say it's 5% for the same example that I was giving. If I were to invest $100, $5 then goes to the collective as well. And that's like revenue that the collective earns basically from onboarding quality projects that receive consistent investment volume. And these collectives, the intuition is that anybody can create one. And they can be around whatever vertical you want. Like if I'm the expert in leather shoes, I can create a collective that only deals with leather shoes. So that a founder that all they want to do is make leather shoes can know that there's somebody out there that's all they worry about. And so at the very least, they never have to worry about like entering a call with a company or a firm or a guy that doesn't know leather shoes or doesn't care. Like, it means that we can handle projects on multiple chains with multiple concepts, like whether it's play to earn or, like DeFi protocols or whatever, lending protocols or NFT drops or art or music or whatever. We can address each of those verticals because it's the community that's doing so. And they're incentivized for doing a positive job and punished, frankly, if they onboard something that is negligible or is malicious. And how that kind of works is that these collectives, they're DAOs, but the DAO structure is upheld by what we call the collective token. So we've basically duplicated our whole protocol layer minus like these commissions for issuing these representative tokens for collectives as well. But the difference is instead of receiving these project tokens, you receive what are called collective tokens. Shocker. And these collective tokens are representative of the collective that they represent. And basically, they are it's like stock in the company, and they can be held, they can be sold back to the protocol, but they can also be staked into the protocol, or staked into the collective that they represent, I should say. And when you do that, when you stake it into the collective that they represent, you basically claim the ownership that you bought. And as a result, you get two things. You get governance rights in that DAO. So you get, it's proof of stake. You get proportional governance rights based on your stake. And then also you get a proportional share of the revenue. So the whole idea is these collectives, they may start from one or two people or even a DAO or even whatever, but they grow into a community. And obviously the initial person who starts it will always have a big say because of the way the economics work around these collectives. But they grow into around the identity, and then the accountability culture is basically socialized in that collective. It's not just one guy who, can whatever. Everybody's kind of got a stake in it now because it's an investable concept. And as a result, then, everybody can take an active participatory role in that due diligence process, in onboarding projects and seeing projects for quality, trying to maintain the vision, the quality, whatever of that collective. And that really is where we get the social investing. This is all about, communities coming together and investing into projects at the project level, fine. And then also, but communities, there's no reason why communities can't come together to support projects, to sponsor projects, because that's what collectives effectively do. When they onboard a project onto the platform, they're really sponsoring it. It's really just like putting my seal of approval behind this project and saying, hey, I think it's worth it. I think it's cool. I'm putting my name behind it, which is something that already happens a lot in the space, except it's always like on Twitter. You know, it's like Gary Vee says, oh, I own OK Bears, right? Like that's like, and that, you know, that has a move on the market, you know, because people like to think that he knows the stuff or whatever, you know, and, you know, so that's really kind of the intuition there. And so as a result, we solve the problem of the risk and security for investors, you know, on the rug side with the protocol. But then really the other side is the curation side, is the discovery side. We solve the problem of, you know, how do I know what's a good music project in Web3? How do I know what's a good art project? How do I know what's a good gaming project? Whatever. The community can lead you there. And that can only help builders, creators, and, you know, the next wave in its own way, you know, in the creator economy. Whether you're from the, like, an actual project founder or you're a curator, like, our whole concept is also that creators want to be the people who support the next generation of creators as well. Like, you know, we've seen that if there's a big vision for you know, whether it's musicians creating their own record labels or artists creating their own patronages or athletes becoming, you know, team owners, you know, there's this movement really for owning your own rights, but also supporting others, because, you know, who best to support a musician than another musician, right? And so, you know, we really want to facilitate that in a way in Web3, and that's kind of what collectives are all about. And so as a creator, you can get involved in a project as an investor or even as a curator in that way and support the next wave of creators.
I think I get the gist of it. So essentially, you are kind of building that social investment right into the platform itself, and you're facilitating any creators who want to raise funds.
Yeah, we feel like it's all about, like, if people want to engage, like, you know, people want to support things, you know, whether even you just look at Patreon, like, that's a fully patronaged website. People are still willing to just support something because they like the vision. Now, you know, we always think that it's cool to be able to invest in something and potentially see the upside of it, you know, support it and see the upside. But when you have that upside built in, a lot of times then that becomes the only concern, right? You know, it's like, I bought something, if it doesn't appreciate, it's their fault. I'm, you know, whatever. I'm no longer, you know, like, it can get ugly pretty quick. And at the very least, we feel that because we offer this security up until the point you're fully confident, we allow for a little bit of that organic support again. You know, people coming in and supporting something because they like the vision, and they can feel a little bit more confident doing that. You know, they can feel a little bit more secure. Just, security is a hard thing to come by in Web3, and we want to, at the very least, give people just that little bit of assurance that, okay, at the very least, I can pull out and I'll be able to get, you know, some of my money back and potentially even more. And that, I think, gives people a sigh of relief and lets them commit a little bit more. Like, one of the things that I always thought was weird was when people, like, when you were on Kickstarter or even with some in projects, or especially in venture capital, because the horizons are so long, when you invest in something, it's kind of, you're kind of tempted to just, like, forget about it because your money's gone. Like, you know, if I give $100 to a project on Kickstarter, until I get the thing in the mail, like, I forget about it because, like, okay, I might read some of the updates, but my money's gone. Like, there's nothing I can do about it anymore. It's, like, done, you know? And we think that's just kind of a bummer. You know, we think, like, we just, as a community, you want, like, the people who support you financially to be there in some way. And the concept of always being able to leave, we feel, weirdly enough, actually encourages you to stay for longer. Because when you leave, you can dust your hands off and forget about it. You know, like, okay, I'm now done. Like, if I decide to leave and sell and I'm gone, like, that's, I can leave. Like, I can forget about it. I can distance myself from ever knowing that project ever. But while I'm here, because I always have that option, I'm here. Like, I'm in the room. Like, I feel a little bit easier and, like, engaging. It doesn't feel like I'm sort of trying to kick a dead horse alive. It's more of, you can have that dialogue and you can have those organic conversations with creators and make mistakes. Like, one of the biggest problems we often think with creators, especially in Web3, is the margin for failure is so minimal, especially in the building process. Like, if something isn't fully functional, or if something isn't as completely intended or as optimized, even if it's a perpetual thing, like if it's a game or something, people often just lose faith immediately. And part of that's because they're fully exposed. They're holding this, if it's like an NFT, they're holding this NFT that, like, oh my God, like, I see the project's going in the wrong direction. I need to get out now. Like, and then that starts undercutting the floor price. And then before you know it, you're on the floor. And with our system, because the liquidity is guaranteed, because investors are fundamentally underwriting their own, and they have these representative tokens, there's this mathematical cover, all of that. We just feel like you can have, like, okay, you make a mistake, maybe some people sell off, maybe some people don't, maybe some people come back in, whatever. You can just have this perpetual concept where you have that feedback and you can take it into an account as a creator and have a healthier dialogue with your investors. And not everything's the end of the world. Not everything's that we just feel that leads to healthier dialogues, better creations, better apps, better products, better whatever, than sometimes we currently see. And so that's really what we're trying to do at the protocol level. And then the whole curation concept is really just, again, that idea of the social side, supporting things and sponsoring stuff.
Absolutely. I think the main problem that even I faced when I was investing in NFT projects was the misalignment in the incentives distributed between the different parties, right? So there's people who are actually creating the project, and there's people who are investing in that project. But is everybody on the same page? Is everybody actually looking to peer through the roadmap of the entire NFT? Maybe, maybe not. I'm not sure. But at the end of the day, what happens is the project suffers, right? So obviously, like how you said, the ability to take that money out and be assured that it's there and the liquidity is assured is a great and a key advantage, I feel, which THEIA is providing that to the investor. So I think this is a platform to look for. So what is this ICO 2.0, which I read in our white paper? What is the proof of concept that you will be introducing as a new thing in THEIA protocol?
Yeah, so that's really the protocol layer that I talked about earlier. It's this concept of no longer are we constricting a fundraise to like an ICO where it's like, boom, it's like this listing. It's basically going public right out of the gate, to where now you have to spool up third-party liquidity pools. You got to like get on a DEX. You got to, and then you got to worry about even the sale, the auction, like all that other stuff. And again, it's just constricted. It's like if the ICO doesn't go well, you're kind of stuck in the water. And even if it does go well, some guy looking to make, a 5% or like a 1% marginal gain could just dump your token on the DEX and take all the liquidity with him, and you're in trouble, right? And so our whole protocol layer, the emphasis is really about two things. Like, one is the security element. Obviously investors come in and they can basically put their money in and then always take a portion of it out. If they want to sell, they can sell back to the protocol. And then two, it's about stretching that fundraise out. But then the third thing is the predictable price element. So how these representative tokens are actually priced is according to basically a bonding curve AMM that is built into every project. So it's the same system across the entire platform, but just the parameters are slightly different, as I mentioned, with like the commission rate and all that. So basically what a bonding curve AMM is that the price of tokens is directly related to supply. So every time a token is brought into supply through basically getting minted by the protocol, the next token bought or sold is more expensive. And then every time a token is taken out of the market through a sale and burned, basically the price of the next token bought or sold is less expensive. And so it's just really simple, really intuitive. And that's how we have this liquidity guarantee, because basically every token sold or bought has its own like price floor, its own like liquidity floor, basically. And it's a mathematical algorithm. It's perfectly covered, so it's predictable. So, like if I were to buy 10 tokens at this point, it's going to cost this much. And so that's how we create that mathematical cover and guarantee liquidity. And then that's also how the pricing kind of changes. Like if I were to invest a little earlier, I get a good deal, and then let's say I'm later on and I want to sell, I'm just not committed to the project anymore, I might actually make a gain. Like I might actually make a gain on my investment, or at the very least I might be flat, or at the very, very least I will always exit for less, for more than it would otherwise if I was just holding a bag that was worth nothing, right? That I couldn't sell. So that's really the kind of the concept behind like sort of the ICO 2.0 is that this, we stretch out that fundraising process in an isolated situation where there's a couple of key advantages. Like one is obviously the liquidity element, but two is it's a more efficient and organic way for price discovery to occur for early projects. Especially for early projects, because if you're starting from zero, it's a really easy way to kind of plot your, for people to come in and invest and find that sort of valuation floor. And then when that is kind of found, the one thing that's great about the system is that the market cap of the project will always be symmetrical to the amount of money invested. So like one of the biggest things that is kind of annoying when you look at projects on dexes or whatever that's done listings, and that leads to a lot of rugs, frankly, is when you have this asymmetrical market cap and liquidity. Like you'll have a lot of times the market cap, which is just the price times the supply, where it can be like in the trillions because they pump the price, but then there's only like $100,000 of liquidity actually on the market. And so then some guy just dumps all the tokens at, and takes basically $100,000 with him. And that's just kind of a rough situation to begin with, but also it's just kind of hard to assess how valuable the project actually is. Like if the market cap's like $1 trillion, you're like, oh my God, it's the best project ever, but it can't be. Like, it's just like it's some early stage product. How does it even work? Like, where's the actual value? And on our platform, market cap will always be the same or basically pegged to the total investment, because the price of these represented tokens only increases when liquidity is brought in. So they're always like raising together. And so that makes it a little bit more intuitive. So that, okay, the market cap's here. That means, that, okay, so this much has to have been invested. So like you can see the commitment from investors, so how much money is actually kind of in the project, and then also like how valuable the project is as a result. And so that's like we feel, especially for earlier to mid stage and even late stage to an extent, like you can have this, more organic price discovery model for investors. And then for projects, our real intuition is that it's one allocation. So when I come to the platform, I deposit a single allocation. It's like one, let's say it's 10%. I do it once. It's the equivalent of like one offering basically. And however, that one offering can be spread out in a perpetual raise, basically over like a long period of time. So the project set that minimum funding threshold, right? And then there's this conversion period that occurs after it. Again, I said they can set the length of that. And basically, that can be as long as they want. So like, let's say I set it for a year, that allocation that I just gave, like that 10%, is split up into weekly conversion events, basically where people can convert if they want to or not or whatever. And they are always entitled to converting as many project tokens for as many whatever. We keep it all proportional and symmetrical. But the intuition there is that 10% of my token is getting doled out over a year, basically, and it's not like fundraising rounds where it's like 10% goes here, then another 10%, then another 10%, then another 10% because I'm going out and I'm trying to accrue more capital later. As my value grows, like let's say I make my product, I'm making it throughout and this conversion period kicks off and the demo releases and maybe an alpha version or whatever, just whatever the project is, and more people are getting interested, more investors coming in, more capital's coming in, and the value is growing for that less and less allocation that's being there. It's the same 10%. So it's like, imagine if Solana was able to, invest, like allocate 10% of their tokens over 3 years or something. You can imagine how they would be better off as a chain because, they didn't have to give 60 of their, 50% of their tokens to like private investors because they just had to constantly go out and do more of these rounds. So it's more of like a way in which you can keep a little bit more of your token kind of decentralized if that's your goal or whatever. You just have a little bit more autonomy with it because that's tokenomics is a much more important thing in crypto than like equity and in traditional capital. Like obviously you don't want to dilute yourself as an owner because you want to own your thing, you want to have the governance, all of that, but there are ways to not get around it, but there are ways to like, you can always issue more stock, you can issue A and B stock. You can like, there's ways in which you can kind of like work the problem in crypto, especially if there's like a hard cap on your token allocation. The minute that cap's there's nothing you can really do. It's like built into the system. Like, so, and then you have to build everything from governance to like the value and all this stuff and the utility of the token right into the thing. So if you have like a play to earn game, where you need like 40% of the tokens to at least be in circulation, otherwise it's just not going to work. You can't afford to like give 70% of it to, one guy, right? And with this model, you can at least have more assurance that you can get the capital you need and accrue even more and more value without necessarily having to dilute yourself further and further and further. And so that's kind of the other pitch beyond all the stuff that I mentioned about like pressure and volatility and all that kind of stuff for project founders. It's really that intuition that, okay, I can take a breath here. I know that 10% of my tokens going here, but I have the potential to accrue so much more value than I would have if I was constantly like ICOing off like chunks of my allocation.
Awesome. I think it was great understanding THEIA from you, and I don't know why nobody has done it till now. It seems like when you say it, it's obviously seems like very simple, but under the hood, I understand there's so many layers to it. I think it's a very efficient way of raising funds, and I really want to see where it goes. So what is your future plan for THEIA? Where do you see THEIA going in the near future?
Yeah, so we really want to, like, we understand Web3 is all about interconnectivity. Like, the idea of being like a super app is a little like, it's just like, no, like, it's like it's cool if you can cover a lot of bases, but you need to accept the fact that you're kind of a node. Like, you solve a problem and you help people at a current stage. You're not everything, right? If we can help people with like a lot of problems, then yeah, okay, we'll capture some market share for a lot of projects and that'll be great. But, we're not trying to like conquer the world of crypto or anything. We're very keen on, staying in our lane and appealing to the people that we want to appeal to. With that being said, we know that our system can appeal to a decent amount, like quite a lot. And especially a lot of the emerging markets or the emerging utilities of crypto and of like the NFT, for example, like really nascent industries like music or even some aspects of play to earn, even though play to earn's been around arguably the longest. There's newer and newer implementations. Like the AAA scene hasn't even come close to it yet. And so we really want to be right at the forefront for like a lot of those emerging markets, and like especially music, especially kind of like art, leveraged art, like also play to earn developers, indie developers, all that kind of stuff, and then protocols as well. And so we want to be, to an extent, a one-stop shop for a lot of founders to be able to come and connect with the communities that they want to connect with and raise capital, appropriately. And so that's kind of our vision going forward. I have been, we're right now launched our V2 of our testnet, which we've had our community been testing and going out, and then we're moving ahead to our basically public launch in August, where we go permissionless, and we have some stages there. And yeah, I mean, and really, a lot of our run up to that is about kind of leading with quality. So we have basically a alpha launch, a beta launch, and then the permissionless launch itself. The alpha launch is basically where the platform becomes the principal collective. So we become like basically the first collective on the platform. We have a pre-curated selection of projects that will onboard, and then people can invest into those and all of that. And then when we hit the beta stage about a month later, we have a curated selection of collectives. So our first rung of guys, and we're really happy with some of the communities that we've aligned with there, and then they'll onboard projects, and and again, it's all investable. And then when we hit the permissionless stage, our goal is to have a lot of quality, when it comes to the curation side of things, and then the projects that are already there, that we kind of set the precedent, that it's like quality. We know that our system rises, like quality rises to the top, but we want to come out of the gate with some quality too. And so then, because once we hit the permissionless stage, we have no say in the due diligence, right? Like it's all community driven, right? So it's not like we can loop in and take control. Like that's not what we're trying to do. So yeah, I mean, but then after that, it's really about, it's about connecting with really future collectives, like, whether it's trying to get like, influential people in the space, whether, it's like Franksy or something in the NFT space. I know he's kind of like a bit wild, or like Steve Aoki or Gary Vee or something, or even like the Winklevosses or something, like, it's that having those people on the platform, taking that collective role is really what's going to push the platform forward. And so that's really what we're going to try and push out of the gate. It's really just about how many sectors, how many people, how many, dare I say the word influencer, can you like attract to want to come to our platform to support people. And then it's just about builders. It's about like what pain points are, people facing the most in some industries. Like gaming is a really good example. There's this chasm between AAA gaming and indie gaming, where there's a huge discrepancy in budget and scope. But there's clearly so much talent in the indie dev scene, like so many incredible games that come from indie developers. And we know that they have the capability and creativity to do incredible projects, but they're just, there's the idea of kickstarting like a $3 million game is kind of like it's a really difficult proposition, because you're basically asking people to shell out a lot of money just to get the game. And we feel that if you can at least have some upside, we know that there's already that desire to support the ecosystem, that a little bit of financial incentive will push people to get involved that much more. And so, that, and then it's just about kind of going sector to sector. Like, what's the issue? Like musicians, they don't want to be exploited by record labels. It's like, okay, well, if you were going to give ownership of your royalties to anybody, it'd probably be your fans. So, go down that route, right? And then it's really about, kind of goes into the broader vision of Web3. There's a lot of infrastructure that's required for Web3 to work in the way that I think a lot of people envision it. Like, it's kind of this weird situation where the technology is kind of beating the infrastructure. Like, there's not really an efficient mechanism to divert streaming royalties to, crypto and then into like a fractionalized NFT, for example. But Spotify has made a commitment that they're going to do that, right? So it's only a matter of time. And then that's a huge thing for, for creators, because then even for us, that allows us an immediate thing of like, okay, we have the Spotify template fractionalized NFT. Like, you can just put that in there and then upload the song, and then it links up, and then you go. And it's all really intuitive, and it's all very simple. or like YouTube revenue or something. Like I'm making a short film, like, and right now there's not really that linkage. We need that linkage if we want to expand completely into the mainstream. There's some cool native things that you can do, like in play to earn, or even in like decentralized entertainment or music or whatever. But if we want to really go into the mainstream, we need to help push that adoption, that next kick in the adoption cycle. And if that means going to, like X company or X, streaming service or X whatever, and say, hey, you guys should consider a strategy here because you could, expand your outreach, whatever, we'll do it. That's really, we want to be a platform and a group that not only appeals to natives, but helps and bring on the next group of new people into Web3. That's really important for us. So we want to try and drive that as much as we can.
A lot of people actually think that raising funds in crypto is so difficult because of the technical aspects associated with it. And I love how you have made it very easy for people to actually raise funds without being always in the doubt that are they getting rug pulled or is it a scam or anything. It's obviously a good way to raise funds, and I wish you the best with the platform and hope for a successful launch in August. On that note, I think that's all the time I have. So thank you so much for joining with us today. And it was great learning about THEIA and all of these insights that you have brought to us.
Yeah, thanks for having me. I really appreciate it.